Hello and welcome to Raghav's Take. Indian stock markets have been supremely confounding since Prime Minister Narendra Modi won a third term in June 2024. Now, that's for pundits and for punters alike. Within 100 days of his re-election, the markets had leapt over 15%, adding almost $8 trillion. You know how much that is? 85 lakh crore rupees. That much in value. The rupee, through all of this, remained rock steady around 84 to the dollar. Just when every investor, including, the proverbial panwala, when everybody got dizzyingly bullish, the market swiveled around sharply. They fell over 15% in 6 months, from October 2024 to March 2025. The rupee plummeted, mark this, plummeted by 5% to 88 to the dollar. And foreign investors sold nearly $15 billion. That's 1.2 lakh crore rupees. Now everybody, including the proverbial panwala, they began predicting doom. And the language that was being used was typical bear language. Who will catch the falling knife? There is no bottom in a bear market. Oh, the rupee will slide past 90 to the dollar. And the goras, colloquially, the foreign investors are called goras. They will sell another 1 lakh crore. Now, in this mayhem, the markets lost almost the entire $1 trillion. I'll repeat, 85 lakh crore rupees. Entire was lost that they had gained after Modi 3.0. When Donald Trump unveiled his astonishing retaliatory tariffs in early April, 145% on China and 26% even on India, at that time the markets fell off a cliff. But in India, it wasn't just a fall. It was actually a stunning bungee jump. Because in a few, very few surreal days, the rupee gained, underline, gained 5%, came back to 84 to the dollar. And the markets recouped nearly half $8 trillion in value. Nobody, I repeat, nobody had any clue or explanation or prediction of this incredible yo-yo. Now, when pessimism was at its peak in March, I was advised to, sell your mid-caps and move into large caps. I was sort of about to press the button on that sale when an alarmed fund manager, he's perhaps the best in the trade, whose portfolio returns have consistently stayed above 20% per annum for over a decade. He's really widely respected. So he called me and he beseeched me to stay put. I asked him a simple question. I said, why? So he said, the market leap after Modi's victory was sheer euphoria. Those bubble-like valuations, they had to blow up. I persisted with my question. I said, but why in September 2024? He said, because foreign money pivoted towards China, where a stimulus yanked up stocks by over 20% in a week. And anticipating a Trump victory along with a strong dollar, investors, shoveled even more cash into American stocks. So foreigners who were sitting on fabulous profits in India, they sold aggressively. I still persisted. My question was, why are you confident that India will recover? His answer, he gave me several points. One, government spending, which had slowed down because of Haryana and Maharashtra polls, is picking up swiftly now. Two, rural demand is showing an uptick. Three, corporate earnings have bottomed out and should start spiking now. 4, Trump's tariffs have made China a touch me not. 5, Trump is tearing down our tariff walls, and less protection will be good for efficiency. 6. Trump is all for a weaker dollar. So naturally, a stronger rupee will make Indian paper even more attractive. 7. We are one of the few countries in the world which is cutting interest rates, and that's because our inflation situation is benign. So, equities will get a natural boost. Now, as he finished giving me this spiel, both of us sort of went silent, thinking about what he had just said, the 7 reasons he had just given. For about half a minute, we were silent. Then suddenly, we blurted out together, "But all bets are off with this Pahalgam war." Again, we fell silent for 30 seconds. Once again, we blurted out together, "But wars are often good for stock markets." What the Second World War did to American stocks is an overarching, perhaps the most indisputable case study. American markets, just remember, American markets lost nearly 90% of their value between 1929 and 1933. That's during the Great Depression. Nearly 15 million, 15 million, that's a quarter of the workforce, Americans were unemployed. Over 9,000 banks failed. GDP shrank by 30%, 30. If ever an economy went through hell, this was it. Ironically, Uncle Sam, that's the US government, was running a small budget surplus during some years in the 1930s. But the beginning of hostilities in 1939, the Second World War, that gave what can be described as an involuntary Keynesian shock. The American budget deficit spiraled by 3,600% to over 50 billion, that's billion with a B, between 1939 and 1943. That's the first 4 years of the war. Now, through the 6-year war, the US government debt quintupled, increased 5 times to 258 billion by 1945. The debt to GDP ratio that peaked at 120%. As American factories hummed, from General Motors to Ford to Boeing to Lockheed Martin to Northrop Grumman, they hummed with wartime production. Soldiers in their thousands, millions were drafted. America hit full employment. Women joined the workforce in record numbers. The Dow Jones, which had fallen to, hold your breath, had fallen to 41.22 points in 1932. That's the beginning of the Great Depression. That surged as soon as Pearl Harbor was attacked and America was pulled into the war. It crossed the 150-point mark in 1941. This was a textbook illustration of what's called the war boom phenomenon. Mercifully, the Pahalgam war, of course, will be nowhere near a world war. Equally mercifully, the Indian economy is nowhere near as ravaged as America was in the Great Depression. So would the principles of the war boom phenomenon apply to the aftermath of the Pahalgam war? Now, instead of guessing, I think it would be instructive to recreate the reality of the Kargil War of May 1999, since the scale of the Pahalgam war could be somewhat comparable. The Sensex was around 4,500 points when the war began, the Kargil War began in May of 1999. It fell very sharply to 3,500 points by June 1999, just 1 month. But in the next month, it jumped right back to parity at 4,500 after the battle ceased in July 1999. Foreign inflows, which had dipped a bit in June, they began surging towards the end of the year, and the Sensex sizzled by over 10% to 5,040 points in December of 1999. The rupee, it took a very marginal dent from 43.44 to 45.46 per dollar. That's during the war. But it too jumped right back to parity in July. In fact, it strengthened. The rupee strengthened a tad to about 42.43 per dollar. Inflation, interest rates, oil prices, gold prices, GDP growth rates, all moot variables. They stayed steady and on course, as if the Kargil War had not happened. So for whatever it's worth, the Kargil pattern was cloned, was repeated by all the markets after the Uri surgical strikes in 2016 and the post-Pulwama Balakot missile attack in 2019. So what can I say? This is QED. This is proof. Because twice can be a coincidence, but thrice is what I would call a forecastable model. So with the standard stock market caveat that past performance is not a guarantee of similar future outcomes, I guess it would be safe to predict that the Pahalgam war would trigger a shallow, perhaps a shallow short-term dip in the stock and currency markets. But investors perhaps will be induced to what's called buy the dip. And once Pakistan is humbled and the shooting has stopped, we should brace for a smart rally. This was Raghav's take today.